Hi, Cole from Boom Finance. Today I'm going to talk to you about which is better, bridging loans or deposit bonds. When selling one property and purchasing another, the funds from the sale may not be available in time to use for the purchase deposit. There are typically two options in this scenario, a bridging loan or a deposit bond. A bridging loan is a short-term home loan designed to allow you to initiate the purchase of a property before you've sold your previous one. Loan terms are often between 6 to 12 months, and bridging loans generally have a higher interest rate than traditional home loans. This can be a great option but carries some risk. It is important to know that you'll be able to make the repayments even in the worst case scenario where your old house doesn't sell as quickly as you'd hoped, or where property values may change unexpectedly. It is important to talk to a broker and ensure that you have the capacity to service the loan for a period of time required. A deposit bond is a tool, upon agreement with the vendor, can replace the requirement of cash deposit when purchasing a property. This can be a relatively cheap method of initiating the purchase of a property, usually without the need to liquidate your other assets. The cost of the bond can vary depending on transaction complexity and the term being sought. In a simple transaction, it is likely to be approximately 1.3% of the amount of the deposit. So for example, for a deposit guaranteed to the value of 10% of the property price for an individual person purchasing an established property in New South Wales and repaying the guarantee within 6 months on a $50,000 deposit for a property purchasing of $500,000, the fee would be around about $650. A deposit bond is issued by an insurer to the vendor of the property for either the full or partial deposit required. At settlement, the purchaser may pay the full purchase price, including the amount of the deposit. At this point, the deposit becomes void. If the purchaser fails to complete the purchase of the property, the vendor is able to give the deposit bond to the insurer, who will provide them with the entire value of the deposit bond. The insurer will then seek reimbursement of that deposit bond from the purchaser. Deposit bonds are generally a fair bit cheaper than a short-term loan, but it's important to talk to the mortgage broker to compare the two, taking into account your requirements and objectives and your financial situation. Therefore, contact Boom Finance to discuss which option is right for you. So go to boomfinance.com.au or give us a call on 1800 464 008.